Isn't it crazy that over 50% of Americans choose to actively lose their money by not investing it? I mean, consider this. If 10 years ago you decided to save or preserve $100,000 due to an almost 16% cumulative inflation over that period, you would have lost $16,000. And in specific areas of the economy, the inflation is even higher than that. I mean, for example, if those $100,000 were supposed to buy you a house, well, now the same house costs around $133,000, so you're still $33,000 short. The reality is, either your money is working for you, or it starts working for someone else. So what I'm aiming for in this video is to do an overview of the different types of assets that you can invest your money in and to find their pros, their cons, and possible winning and inevitably losing strategies. A little note, I will not be including conservative types of investments because those mostly just allow you to barely beat the inflation. What's the point? I'll be using, anonymously of course, the investment stories of my two dear friends. Let's call them Alan and Steve because, well, those are their names. How did it work out for them? Well, watch to the end, and as it often happens with investments as well, the results might surprise you. So let's go! Stocks are shares of ownership in publicly traded companies which are traded in the stock market. Now, stock prices are driven by various factors, but the price at any given time is mostly regulated by the supply and demand for the said company's shares. Now, over the last 100 years, big stocks have provided, on average, a 10% return rate. Now, my friend Alan, he's a big fan of the film Wolf on Wall Street. Well, at least he's a big fan of the first couple of hours, before everyone gets arrested and goes to prison. He wants to make some money quickly, so when the market was going up, he bought some shares of Netflix, a popular streaming service you might have heard of. Their price was growing at the speed of almost 100% per year. Steve, on the other hand, entered the stock market during the recession, so the initial purchase price was much lower. He set up a 5-year plan and bought shares of several established S&P 500 companies, including Netflix. Now, Alan's stock price was growing for a few months, but then the market entered a recession, and the price soon went below the original one. So he panicked, and he offloaded his shares and unsubscribed from Netflix the next day. That'll show him. Steve didn't panic because his share prices were going down for about a year, but as the market started growing again, so did his shares, including Netflix, because apparently Alan hadn't hit them hard enough. What a pity. Clearly, when you're just entering the stock market, it's not a great idea to put all your eggs in one basket and time your actions according to your emotions. Investing in stocks are medium risk and medium return. They also have a high liquidity, which means that you can buy or sell your assets quickly and easily at your leisure. The majority of housing markets have seen between a 50 and 100% increase in price over the last 20 years, so it appears to be a solid investment. When you invest in real estate at one of the earlier stages of its development, you can actually get a high return when the project is ready and sold. For example, Alan's friend persuaded him to join a group of investors and put his money into a luxury condominium on the seaside. The area was underdeveloped, but it had a lot of possibilities. Steve, on the other hand, did a lot of research and saw an opportunity to invest in an office block in a busy urban area undergoing gentrification. Now, Alan's plan had turned out to have a major issue, unfortunately. The area was not developing as fast as it was predicted, so the construction took a little bit more money and a little bit more time, and when the project was finally finished, nobody wanted to pay the predicted price. While Steve's office block, on the other hand, was sold way before it was even finished. So, investing in real estate can be medium to high risk and bring medium to high return. But an awful lot depends on the specific situation, as it's more of a business project than really an investment. The liquidity is also extremely low, as it might be difficult to find a buyer for your share of the project. if you, for some reason, decide to sell it. Cryptocurrency is digital money secured by blockchain technology. You can buy and sell crypto coins on a crypto exchange pretty much the same way as you would with stocks. Some of the world's richest boomers, people, say they will never invest in cryptocurrencies. But Alan has his own billionaire celebrity idol, Elon Musk. Alan noticed that the crypto market and the main currencies like Bitcoin, Ethereum, and so on and so forth are in the middle of a long recession. But recently, Elon has been using his Twitter to back a new meme coin called Dogecoin. Its price has actually been growing quite steadily, sometimes as fast as 50% a day. And well, Alan, of course, thought that he could buy some, wait for a while, and then when the price starts going down, sell it. And yes, before you remind me that Alan's money is actually all tied down in the doomed Seaside project, not to worry. His uncle died. He jumped out of a window and left an inheritance. Alan has a great family. They're really supportive when it counts. His words, not mine. Steve actually didn't mind the market's downward trend, so he purchased about 12 different cryptocurrencies at a low price, especially the ones which were the most integrated into the global mainstream financial systems. So how did this go? Well, Alan's Dogecoin was growing and making him very excited until Elon called it a hustle on a primetime TV show. The price dropped by over 30% overnight. Then, within a few days, it was 1.5 times lower than Alan's original purchasing price. And in a few weeks, it was over 3 times lower even than that. Needless to say, Alan was having serious thoughts about following his uncle's example. Steve, on the other hand, has high hopes for his crypto investments, and by the way, in my previous video, I tried to explain why investing in cryptocurrencies could actually be a good long-term plan. But now, with extremely high risk, extremely high possible returns, and very high liquidity, well, the crypto market is like the stock market on steroids. Even worse, because the cryptocurrency's objective utility is much harder to assess than one of a publicly traded company. But the same rules about diversifying your portfolio, doing research, and following a plan still apply. There are no miracles. Investing is not a Disney film. There's no Disney movie called Boring Old Guy and His Completely Non-Magical Hedge Fund, although I might actually watch that. Startups are companies at the initial stages of development, but sometimes they attract outside investors before they get off the ground. Now, I'm sure that you've read somewhere that 9 out of 10 startups fail. Well, I couldn't really check if that's true because the startup which conducted that study went out of business last year. But maybe it's not so bad. So Alan wanted to finally invest in something foolproof, solid, something that really works. So when his friends told him, hey, there's this great developers team and they're working on an app which can help you find ghosts, well, he obviously immediately invested. Steve, on the other hand, decided to invest within his sphere of competence. He used to work for a pharmaceutical company, and when he learned that a new startup is offering a faster, easier, and painless technology for blood testing, Steve did some research and invested his money. And, well, you might think that you know how the story ends. A few years in, it was revealed that the tech Steve's startup was using had a fatal flaw which they'd been concealing, and the company went bankrupt soon after. While Alan's Ghostbuster app apparently became a huge sensation on all the marketplaces. Basically, remember all those loonies who wanted to storm Area 51? Well, they all got it. And the development team has now expanded and is already working on a couple of new apps for detecting vampires and turning werewolves back into people. Humans are funny. So startup investments can be very high risk, very high return, and very low liquidity. And it can also remind us of one very important detail, that with investment, you can never be 100% sure of anything. So what can you do? You can do what Steve did. After the failure of his startup, he jumped off his balcony and into his private pool, which he could afford due to his other investments being successful. So to sum up, learning to invest your money can be hard, but it's a skill that we all have to master if we don't want to be constantly losing it. There are a million things to learn, but I guess we should all start with the basics. Don't put all your eggs in one basket. Don't invest money that you can't afford to lose, and have your investment plan and stick to it. Always do your own research, and finally, always be ready for surprises. For more cool insights into the world of money, finance, and investments, inspiring success stories, and terribly exciting tales of failure, subscribe to this channel and like our video. I'll keep them coming. See you soon!